Look at Grab holdings right now. I mean, is this a falling trend hiding a massive sell signal, or is it a ridiculously undervalued strong buy that the market is just completely mispriced?
Oh, is the ultimate Rorschach test for investors right now. You look at the same chart, the exact same financial filings, and you can walk away with two completely opposed narratives.
Right, mostly depending on your tolerance for emerging market volatility.
Exactly.
And that is basically the mission of today's deep dive. We are unpacking the technicals, the underlying financials, and the incredibly intense bull versus bear debate surrounding Grab Holdings Ltd.
Ticker symbol GRAB.
Yep, GRAB, as of today, April 20, 2026. Crucially, though, a quick disclaimer before we really get into the weeds. What we're doing here is having a natural human debate for educational and entertainment purposes. We're looking at the data, but absolutely no financial advice is being given.
Right, we're just decoding the signals the market is flashing and, figuring out the mechanics behind them.
No financial advice at all. Oh, and before we jump into the numbers, you need to like this video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave us a comment with your feedback.
We really want to know where you stand on this stock.
We really do. Okay, let's unpack this. We have a stock that is deeply polarizing. So what is the immediate reality of Grab stock on the tape today?
Well, the immediate reality is that we are witnessing a stock trying to violently wake up from a prolonged hibernation.
Violently wake up. I like that.
Yeah, because as of our latest market data, Grab is currently trading at $4.21. And in the last trading session alone, it jumped up 4.73%.
Which sounds great, but
context dictates everything here, right? That 4.73% leap isn't happening near all-time highs. It's bouncing directly off a brand new April 2026 52-week low of $3.48.
Okay, so we are sitting uncomfortably close to the floor of a 52-week range that peaked at $6.62.
Exactly.
But here is where I struggle to buy into the short-term hype. The macro trend has just been punishing.
Oh, absolutely.
I mean, a 4% bump doesn't erase months of distribution. The long-term trend is still under pressure because we're trading below the 200-day moving average.
Right.
It feels like trying to swim upstream. How do we know this short-term bullish bounce isn't just a fake-out, like just algorithmic short covering?
What's fascinating here is that the underlying mechanics of the price action point to an accumulation phase, not just a fake-out.
Really? How so?
Institutional buyers are stepping in. The momentum indicators are screaming this. The RSI, the Relative Strength Index, is currently sitting at 68.96.
Wait, at nearly 69 on the RSI, we are right on the edge of overbought territory.
We are.
Doesn't that imply the spring is wound a bit too tight for new buyers stepping in today?
Ordinarily, yeah, you'd think so, but you have to look at the breakout levels. So the MACD is flashing a buy signal at 0.109. And the price is finally crossing above both the 50-day moving average, which is at $3.86, and the 200-day moving average at $3.75.
Ah, okay, so it's shattering those resistance lines.
Exactly. It didn't just cross them, it pushed right through. Algorithmic traders are triggered by those specific crossovers, which is why the daily signal is a consensus strong buy.
Got it. So where are the key battleground levels for you right now?
Well, support sits at $3.73 and a tighter floor at $3.90.
Right.
While resistance is at $4.14, which it just pushed against. And the next major target looking up is $4.50.
But, charts only show us what traders are doing. The technicals are just the footprints in the snow.
Yeah, they show the what, not the why.
Exactly. The financial statements reveal the actual business mechanics, the why they are doing it. And looking at the full year 2025 results, I mean, the turnaround story is undeniable.
It really is an inflection point.
Yeah.
Grab is no longer just a growth at all costs cash incinerator.
Not at all. For the first time in the company's entire history, Grab reported a full year net profit. They posted $200 million in net income for 2025.
Which is huge.
It's massive. This is a company that bled out a $158 million loss in 2024.
Right.
Total revenue hit $3.37 billion, which is a 20% year-over-year jump. Adjusted EBITDA reached $500 million, and they posted a positive adjusted free cash flow of $290 million.
Achieving GAAP profitability in the ride-hailing and delivery sector is, well, it's incredibly rare.
Yeah, Uber and Lyft struggled with it for years.
Oh, for a decade. The historical model for these companies is to raise billions in venture capital, subsidize rides to artificially acquire users, and just pray that someday the unit economics flip.
Most of them never figure out how to stop the bleeding.
Exactly.
So comparing Grab's balance sheet right now to, say, Financial Fortress isn't even an exaggeration. I mean, they're sitting on $11.98 billion in total assets. And the liquidity is just staggering. A massive $7.4 billion in cash and cash equivalents against total debt of only about $2.05 billion.
So that leaves them with a net cash position of what, $5.4 billion?
Safely at $5.4 billion, yeah.
If we connect this to the bigger picture, this cash pile isn't just a safety net, it's a weapon.
A weapon? How do you mean?
Well, when interest rates are high, debt-heavy competitors are paralyzed. They spend all their cash servicing their debt. Grab's $5.4 billion net cash position means they can fund research, subsidize expansion, or just buy out struggling competitors without needing expensive loans.
They've effectively transitioned from a cash-burning startup to a financially stable super app.
Precisely.
Okay, so if the financials are so solid, who is actually stepping up to buy or sell? We really have to follow the order flow to see if the smart money is actually buying this turnaround narrative.
Right, follow the money. And the 13F filings show a clear pattern. As of the fourth quarter of 2025, 61 different hedge funds held positions in Grab.
Oh, wow, 61.
Yeah, which is a noticeable uptick from the prior quarter. But the most aggressive buyer in the market right now isn't a hedge fund.
It's Grab itself, isn't it?
Exactly. The company executed a $500 million share buyback program in 2025.
And they just authorized a brand new $400 million program for 2026 to support the price.
Right. When management buys back stock, they're effectively telling the market that out of all the possible investments they could make, acquisitions, marketing, whatever, the best ROI is their own stock.
But let's pause here, because there is a bit of a red flag, or at least a glaring contradiction that we need to talk about.
The insider shakeup.
Yes, the insider shakeup reported in March 2026. We know there was a shakeup, even if specific massive sell-offs aren't clearly detailed in the filings.
Yeah, it definitely introduces some psychological friction.
Right. I mean, when the company's buying back shares but the C-suite is shuffling around, how should a retail trader interpret that?
It forces you to ask, what do they see internally that we don't see on the balance sheet? Is there a disagreement on the future direction? Or, is it simply founders and early executives realizing they've hit profitability and wanting to step back?
But the market hates ambiguity, and that insider uncertainty naturally pivots us to the central debate ripping across trading desks right now.
Is it truly undervalued or a classic value trap?
Exactly. Because if you look at the setup, analysts give Grab a consensus strong buy rating with an average price target of $6.31 to $6.67.
Which implies a massive 50 to 60% upside from where we are today.
Right. Most analysts view it as undervalued relative to its growth.
But this raises an important question regarding valuation. You have to push back on that bullish math for a second.
Let's poke some holes in it.
The PE ratio, the price-to-earnings ratio, is sitting sky high at roughly 64 times earnings.
64x multiple.
Yeah, because their GAAP earnings are still in their infancy. You aren't paying for what the company is doing today. You are paying a massive premium for future dominance.
It's like buying a front row ticket to a concert where the band is only just tuning their instruments. You're paying a premium for what you just hope they play.
That is a perfect analogy. And the bears argue that the band might not even know the set list yet. This is exactly why retail traders often get trapped here.
Trapped by the super app narrative.
Yes. Despite the super app status, there are significant downside risks and volatility. The first major risk is soft guidance. Grab recently issued their revenue guidance for 2026, projecting between $4.04 billion and $4.10 billion.
Which missed some of the more aggressive market estimates, right?
It did. And when a stock trades at 64 times earnings, Wall Street punishes any hint of slowing growth. The underlying cause of that soft guidance is persistent inflation in Southeast Asia.
Oh, right. It's strangling consumer discretionary spending.
Exactly. Unlike some Western markets, the Southeast Asian consumer is highly sensitive to price shocks. When inflation bites, premium food delivery is the first thing families cut.
Taking a private Grab car instead of public transit suddenly feels like an unjustifiable luxury.
Right. And if they aren't opening the app for rides or food, they aren't seeing the high-margin advertisements or using the fintech lending products.
The whole flywheel slows down.
Exactly. And compounding that is the heavy competitive pressure. They are locked in a street fight with GoTo and Lineman.
Right. GoTo is massive in Indonesia.
Huge. And when competitors are willing to operate at a loss to steal market share, it forces Grab to keep prices low, eating into that $500 million EBITDA.
So, having established the risks, the conversation naturally turns to the horizon. What will trigger the best case recovery scenario or the worst case continuation lower?
Well, the short-term horizon has an immediate hurdle.
Q1 2026 earnings.
Yep. Dropping in a few weeks on May 4, 2026. This will be the ultimate test of their short-term strength or weakness. We will see if that recent bounce was smart money positioning ahead of an earnings beat or just noise.
Okay, but what about the medium to long-term catalysts? The bull case.
The bull case highlights the long game. Grab's entry into high-margin advertising and fintech is a massive driver. Furthermore, they are using their cash pile to consolidate.
Like the foodpanda Taiwan acquisition.
Exactly. Their $600 million acquisition of foodpanda Taiwan is projected to drive EBITDA growth by 2028 because they gain immediate pricing power and eliminate duplicate corporate overhead.
And they are innovating on the mobility side, too.
Oh, absolutely. They just launched a new autonomous ride service in Singapore alongside WeRide
Yeah.
robotaxis.
Which is the holy grail for ride-hailing margins.
It is. You remove the human driver, you turn a labor-intensive logistical nightmare into a pure software routing network.
But we have to balance this by outlining the worst-case scenario. Innovation requires a long runway.
It does.
If the regional economic headwinds and inflation persist, and the premium 64x valuation isn't justified by the upcoming May earnings.
The stock could easily lose its recent momentum.
Exactly. It could test the 52-week lows, again, maybe slice right through that 3.48 floor. It could languish as dead money for years while the earnings slowly catch up.
It really tests your fundamental philosophy as an investor.
It really does. So to quickly recap the incredible tension in this stock, we are looking at a company sitting on billions in cash, celebrating its first ever annual profit, yet they are battling high PE ratios, soft guidance, insider shuffling, and fierce regional competition from companies like GoTo.
It's a historic tension.
Which leaves us with a final provocative thought. So what does this all mean for you? If Grab is successfully transitioning from a ride-hailing and delivery service into a massive, high-margin fintech and advertising giant...
The super app model.
Right. Are we currently looking at the cheapest this stock will ever be? Or are those Southeast Asian economic headwinds going to create an even deeper discount later this year?
And, could their proprietary behavioral data end up being the real Trojan horse here?
Oh, that's a fascinating angle.
They know exactly where millions of people travel, what they eat, how they spend. In an AI-driven world, that data set is pure gold.
It really is. A lot of uncertainty, a lot of potential.
Absolutely.
Well, don't forget to like, subscribe, and leave your thoughts in the comments below. We really want to hear your bull or bear case for Grab.
See you in the comments.
Until next time, keep your eyes on the data.